What is the stock market? For many people, the stock market is either a big dream or a terrifying mystery. For some, it's a money-making machine. For others, a maze filled with losses. So what exactly is the stock market? How does it work? And why do some people manage to earn consistently for years, while most others get stuck in the same basic mistakes? Today, guided by the book How the Stock Market Works, we're going to understand how the stock market really works behind the scenes. And hopefully, by the end of this video, the stock market will no longer be a puzzle to you. It will become a functioning system. If you're ready, let's begin. 1. Section. What is the stock market, really? At its core, the stock market is a huge marketplace. But this marketplace doesn't sell fruits or vegetables. It sells companies. When a company wants to grow, open new branches, invest in technology, or expand its production capacity, it needs money. To raise that money, companies offer their shares to the public. And what they're essentially asking you is this: would you like to become a partner in this company? What you buy and sell in the stock market is not just a chart on a screen. This is the most emphasized point in the book. A stock is a partnership. If the company grows, you grow. If the company is poorly managed, you lose. This is why the stock market is often called the heart of the economy. It's where capital and investors meet. 2. Section. How are stock prices determined? The numbers you see on a stock market screen are not random. A stock's price is determined by one simple thing: supply and demand. If many people want to buy a stock, the price rises. If many want to sell, the price falls. But supply and demand are influenced by economic events, global news, investor psychology, and the company's actual performance. The book highlights a very important sentence. Price is a reflection of what people think about the company. So the price is a result, not a cause. 3rd section. Why do people invest? According to the book, people enter the stock market for 3 main reasons. 1. To save and build wealth. Long-term investors have one clear goal: building wealth. 2. To generate income. Some companies pay dividends, meaning they share part of their profits with you. This is one of the most powerful ways to create passive income. 3. For speculation. Trying to profit from short-term price movements. The book gives very clear advice. Beginners should avoid speculation. Short-term price movements are risky and unpredictable, especially for someone who lacks experience. 4. Section. How do you understand a company's real value? A company's true value is understood through 3 main factors: profitability, growth potential, risk level. The book emphasizes one crucial idea. An investor buys the future, not the present. If a company has a bright future, its stock price will eventually reflect that. So when choosing a stock, here are the questions we must ask. What does this company actually do? How has it performed in the past? What opportunities does it have for the future? What is its debt situation? Is its sector growing or shrinking? The foundation of winning in the stock market lies in answering these questions correctly. 5. Section. What is fundamental analysis? Fundamental analysis focuses on the company, not the stock price. You examine the balance sheet, the income statement, cash flow, profitability ratios, management quality. The strongest message in this part of the book is: an investor who doesn't understand the balance sheet is blind. No matter what the chart shows you, if the company's financial health is weak, the stock will eventually disappoint you. This is why research and caution are essential. 6. Section. What is technical analysis? Technical analysis focuses on the price itself. It examines charts, patterns, trends, and market behavior. The book describes technical analysis as the art of managing probabilities. But it clearly states, technical analysis is not a prophecy. It can guide you, but it cannot make decisions for you. When beginners misunderstand this, big mistakes happen. 7. Section: Risk Management, the most important part. One of the most critical chapters in the book is risk management. Because in the stock market, earning money is important, but not losing money is just as important. Here are the book's risk management principles. Never put all your money into one stock. Every investment must be based on a scenario. Cut your losses early. Let your winners run. Know your risk tolerance. Not everyone can handle the same level of volatility. The real goal in the stock market is not to get rich fast. It's to stay in the game. 8. Section: Market Psychology, the Hidden Force. Stock prices are not determined only by company performance. Human emotions play a massive role. Here are the traps new investors often fall into. FOMO, fear of missing out. Panic selling during declines, overconfidence after a few wins. Herd mentality, buying just because everyone else is buying. The book says, your biggest enemy in the stock market is not the chart, but your own emotions. That's why you must control your emotions. Stay calm, stay patient, and stay consistent. 9. Section: The Power of Long-Term Investing. The stock market may seem chaotic in the short term, but in the long term, there is order. The book highlights 3 truths. Time reduces risk. Patience grows compound returns. Frequent buying and selling leads to losses. Patience leads to gains. As Warren Buffett famously said, the best holding period is forever. Closing. In summary, the stock market is a massive ecosystem where companies, people, emotions, and the economy intersect. To navigate this ecosystem successfully, you need 3 things: the right information, the right psychology, the right strategy. If this video helped make the stock market clearer and more meaningful for you, then you are definitely on the right path. Don't forget to like the video, subscribe, and turn on notifications for more content. See you in the next one.